$8 trillion. I mean, just let that sink in for a second. It is an almost unfathomable amount of money, yet it represents the estimated total financial burden of the post-9/11 wars. It's a truly staggering figure, and it completely reshapes how we understand national budgets, global conflict, and the true, lasting cost of mobilization.
So where on earth does a number like that even come from? Well, today we're looking at some incredibly thorough, impartial research from the Costs of War Project over at Boston University and Brown University. Throughout this explainer, we're basically going to act as objective auditors. We aren't here to debate politics. We are just looking purely at the ledgers. We want to examine these massive data points to see exactly what happens to a nation's finances and its financial markets when it goes to war.
Welcome to unpacking a fascinating and honestly kind of mind-blowing dichotomy that I like to call the two ledgers. On one side, we have this immense multi-trillion-dollar budgetary burden placed on the nation. But on the other side, we have the historical reaction of the stock market. And as you'll see, these two ledgers tell very, very different stories.
Here's a quick roadmap of what we'll cover today. First, the $8 trillion bill. Second, where the trillions go. Third, the credit card wars. Fourth, Wall Street during wartime. And finally, why markets hate uncertainty.
All right, part one, the $8 trillion bill, tallying the true cost. Let's dive right into this first ledger. Now, if you look at direct government spending, the United States has shelled out roughly $5.8 trillion in reaction to the 9/11 attacks. But here's the kicker. That's not the final bill. The true cost actually balloons to $8 trillion when you factor in an estimated $2.2 trillion in future obligations. See, the financial costs don't just magically stop when the fighting in major war zones stops. We're looking at a massive, long-tail financial commitment that stretches all the way out to 2050. Moving on to section 2, where the trillions go, visualizing the budget. Trillions are, notoriously hard to wrap your head around, so let's break this down into buckets. When most of us think about the cost of war, we picture the battlefield, right? But check this out. It's a pretty shocking disparity. The $2.1 trillion spent on direct military operations overseas, it's actually less than the estimated $2.2 trillion needed for future veterans' care. Because of amazing advances in modern trauma care, far more service members are surviving their wounds today, which is fantastic, but it means they are going to require highly specialized medical and disability care for decades to come. And the ripple effects go way beyond that. We've got expanding homeland security operations to prevent future attacks, eating up over $1.1 trillion. Then, you've got the base military budget, which was heavily inflated by the conflict, adding another $884 billion in enduring costs for things like higher pay, healthcare, and expensive contractors. Toss in the $465 billion already spent on veterans care through 2022, plus $189 billion for the State Department, and yeah, you can quickly see how that national tab explodes. Which brings us to section 3, the credit card wars, financing the conflict. So this begs a huge question. How did the U.S. government actually pay for all of this? Historically, wars trigger an immediate surge in public funding, like a dedicated war tax or massive war bond drives. But not this time. These post-9/11 operations are often called the credit card wars. Instead of taxes or bonds, the country just dove headfirst into deep deficit spending. The government essentially swiped a multi-trillion-dollar credit card to fund a global mobilization. And, well, just like your own credit card, the interest eventually comes due. Thanks to this borrowing strategy, the interest payments alone on this war debt have hit a jaw-dropping $1.087 trillion. $1 trillion just in interest. And remember, that number is only going to keep compounding and snowballing over time unless the underlying debt is paid off. So, with $8 trillion draining out of the national budget, crazy deficit spending, and global instability on the rise, you'd probably think Wall Street would absolutely panic, right? You'd assume the stock market just craters. Well, let's flip over to our second ledger and see what actually happens to the market when the world goes to war. Section 4, Wall Street during wartime, the investor's ledger. We're pulling some historical data here curated by the Motley Fool, and it reveals a really counterintuitive reality. There's this pervasive myth out there that war bankrupts the stock market, but the reality? Completely different. Historical analysis covering a century of conflicts shows that U.S. large-cap and small-cap stocks consistently deliver positive returns during wartime. Actually, scratch that. They often outperform typical peacetime market averages. Just look at the hard historical data for the S&P 500. During World War II and the Korean War, large-cap stocks jumped roughly 17% and 19% respectively. The Gulf War saw an 11.7% return, and the Iraq War delivered almost 10%. Those are incredibly robust numbers that directly challenge our natural assumptions about conflict and economic collapse.
Now, it's not a perfectly smooth ride, obviously. The timing of the conflict dictates a lot of the initial reaction. Surprise attacks, think Pearl Harbor, absolutely trigger immediate, sharp market chops. And pre-war jitters are very real too. The S&P 500 fell over 12% in the 3 months leading up to World War II. But the broader pattern is undeniable. Once a conflict actually begins, stocks tend to completely shake off that downward pressure. In fact, stocks rose over 10% in the 3 months immediately following the start of the Gulf, Iraq, and Afghanistan wars.
All right, our final section, Part 5, Why Markets Hate Uncertainty, the Psychology of Wall Street. To understand why Wall Street is rallying while the national debt is absolutely skyrocketing, we have to look past the numbers and dig into the underlying investor psychology. It boils down to this: markets do not actually fear war itself, they fear uncertainty. The anticipation of a conflict is a giant unknown, so prices dip as tensions simmer. But paradoxically, once a war starts, the outcome becomes a risk that analysts can actually model, predict, and price into the market. Certainty, even when it's a grim certainty, is exactly what allows markets to rally. Let's track how this stabilization builds step by step. First, geopolitical uncertainty spikes, depressing prices. Second, the war officially begins, which brings clarity. Third, massive government mobilization kicks in. Remember that $2.1 trillion from earlier? That cash floods into defense and aerospace contracts, creating incredibly stable long-term revenue streams from massive corporations, which lowers volatility in those sectors. And finally, with those profits easier to forecast, overall investor anxiety eases up and the broader market stabilizes. So what's the core takeaway for anyone navigating the markets during turbulent times? It's summarized perfectly right here. Sticking to a long-term strategy is absolutely crucial. The most dangerous thing an investor can do is engage in emotional trading during the unpredictable, chaotic early days of a conflict. Over the long run, history heavily rewards those who hold their positions and wait for certainty to return. As we wrap up this explainer, I want you to think about these two vast, completely contrasting ledgers. On one side, we have an $8 trillion national debt burden, fueled by credit card wars and massive, decades-long obligations to our veterans. On the other side, we have highly resilient financial markets that absorb global shocks, price in the risk, and consistently march upward. So consider this. How are these twin forces, a soaring national deficit and a deeply pragmatic stock market, silently shaping your own personal financial future?